You guys, welcome to tonight's class. So this is class 3 or 4 for FAC4862, FAC4864. I think some of you received your letters to say whether you're in or not. So I think so. So now you know that you're most likely in, and now you need to push, because it's just like a few more weeks and then you're gonna write your finals. So you came this far, so give it your best shot so that when you get the results at the other end, sometime in November or December, I don't know, it'll be, you'll put a smile on your face. So today we're gonna do the actual answering the actual question. So the first lesson we went through the scenario talking about certain aspects. Yesterday we explained how to put together a statement of changes in equity. So now we're actually going to go about doing the calculation. Tonight's class is going to focus on calculating profit or loss from a group perspective. So remember, when we calculate profit or loss, there's going to be a one row called profit or loss, but it needs to be split between what belongs to the parent and what belongs to NCI. The portion that belongs to NCI goes to the NCI column, and the portion that belongs to the parent goes to the retained earnings column. Okay, so that is what we're going to be focusing on. So the way I approach this is as follows. I do a separate profit or loss calculation for each entity. I start off with the profit or loss given, and then I make the necessary group adjustments. The necessary group adjustments are two types. One, intercompany transactions, as well as transactions at acquisition. Okay, so I'll talk to you about the various ones at acquisition. So that's important to take note. Then once I start off with the profit or loss given, and I make the group adjustments, that gives me profit from a group perspective, but that is 100% profit. So then we say, okay, which of this profit belongs to the parent and which of this belongs to the NCI or the other party? Okay, so that is basically the approach that I take. And then we just add up all the profits that belong to the parent to get the parent's portion, and we add up all the profits that belong to the NCI to get the NCI's portion. Okay, so it's quite structured, and you can follow it no matter what. So if you're not dealing with a complex scenario, there's no need to do this long approach. But like this is a complex scenario, it's better to take maybe an extra 2 to 3 minutes and know that you're going to get the right answer. Okay. So I'm going to be switching. So what I need, if you can open up the scenario on your side, because I'm going to keep open the Google Sheets on my side. Okay, so I'll be reading from my side the scenario, but you're not going to see it. So make sure you can see the scenario from your side. Okay, so you should be able, okay, I don't know if you can see it yet. It's still loading on my side. Okay, so it's done loading. You should be able to see it. Do you see it? Okay, so let's go and answer this question. Okay. So we're going to have opening balance. I'm just going to copy this for now. So here we go. So I'm going to check what the required is saying. part A. Okay. Okay, so what we're going to focus on, we're going to focus on calculating profit or loss for the year. So remember, profit or loss is in like the parent's portion is in come under retained earnings, and NCI's portion is in a come under NCI. So how am I workings over here? You start your workings on a separate page. So this is my separate page. Okay, so here I'm going to have working one. So I'm going to work out profit for the year. So I'm going to start off with the profit for the year relating to, who's the group again? Mumbai. Okay, so remember we have Mumbai, we have Fifi, we have New Delhi, and we have Kolkata. So on page 45, right, that's the first page of question 1. You can see the profit given is right at the bottom on that page. So for Mumbai, it is that 1 million. For Fifi, it is 520. For New Delhi, it is 290, and for Kolkata, it is 207. What's important to take note, you must make sure you don't mess up the type of entity. Okay, so you must know that Mumbai is the parent. You must know that Fifi is a foreign subsidiary. Okay, you must know that New Delhi, I think, is an associate, and Kolkata, I think, is also a sub. I can't remember. Kolkata is also a sub. Okay, so please make sure that you don't mess up that, because if you mess up that, you know you are gone. Okay, so make sure you have your financial year written out somewhere. Make sure you draw out the diagram, that the parents on top. He has 3 investments, which is Fifi, New Delhi, and Kolkata. Then by Fifi, you will say foreign subsidiary. By New Delhi, you will say associate. And by Kolkata, you will say subsidiary. Please don't mess that up. If that is messed up, there's nothing that will help, that will save you. Okay, so please make sure you get that right. So rather spend time writing that down. Okay, now I'm going to complete my, so now I'm going to do the calculations. So I'm going to start off with Mumbai's profit. Okay, so Mumbai profit. I start off with the profit that is given. So the profit that is given is 1.5, like that. Okay, so that was given. Now that is 100%. Okay, so we're okay with that. So I started off with the profit as per the profit from Mumbai, the separate company. Now I ask myself a question. Is that the number that the group wants? The group wants 100%, but is that profit of 100% from a group perspective? The answer will be yes, if there are no group adjustments? The answer will be no if there are group adjustments. Remember, there are two types of group adjustments. Group adjustments relating to intercompany transactions and group adjustments relating to transactions at acquisition. So we know there are intercompany transactions. We know Mumbai had intercompany sale of inventory and so forth. So we know there are unrealized profits. What's important to take note over here? Okay, so what's important to take note over here? And that is why you need to make sure when you work through the intercompany journal entries that you understand what the journal entry is doing. So with the intercompany journal entry, right, for inventory, I told you there are 3 journal entries. The first one is to eliminate the sales and cost of sales. The second one is to eliminate the unrealized profit. And the third one is, so the second one is to eliminate the unrealized profit included in closing inventory. And the third one is to eliminate and recognize the unrealized profit relating to prior year's closing inventory. In other words, this year's opening inventory. Now, with that first journal entry, the journal entry goes as follows: debit revenue, credit cost of sales. So what you should know that you are decreasing revenue. As a result, you are decreasing profit or loss. Then you are crediting cost of sales. So that means you are decreasing cost of sales. A decrease in cost of sales increases profit. So the one part of the journal decreases profit, the other part of the journal increases profit. So the impact on profit is 0. So therefore, there's no need to bring that. When you do a profit calculation, we don't need to bring in that journal entry number 1 of eliminating sales and cost of sales, because the impact on profit is 0. You have to do it when you prepare a profit or loss statement. But when you calculate profit or loss, there's no need to do it, because when you're preparing a statement of profit or loss and other comprehensive income, we see every single line item. We see sales, we see cost of sales. So all we are doing with the first journal entry is to make sure the disclosure is correct, is that we're not overstating revenue, nor are we overstating cost of sales. But but the impact on profit is 0. So when we're doing a calculation, there's no need to bring that in. So but just be aware of that. They won't penalize you, but it does show that you're not thinking if you include it. Okay, so just be aware of that. So so take note. So that is why I won't show it over here. I'll actually just show it, and then I'm going to remove it to show you what I mean, that it is 0. The impact on profit or loss is 0. But remember, in your calculation, you won't do it. So what we need to ask ourselves, is there any fair value, is there any intercompany transactions that we need to consider, right? So the first thing to look at is there any intercompany transactions, and remove that. Then you might just ask, we must not forget to consider if there's any dividends that you need to remove. Okay, so included in other income could be dividend income that we're receiving. So we might just have a look at that. And then also you must have a look if there's any other transactions that impacts the parent's profit or loss. So this one over here, the parent's profit or loss calculation generally is a little bit more challenging. Why is it more challenging for most students? So it's not actually challenging, but why it is more challenging is we are used to doing an analysis of equity. Now, analysis of equity only focuses on the subsidiary or the associate or the joint venture. There's no analysis of equity for the parent's profit. So that is why many of us struggle with calculating the profit for the parent, because we don't know, we can't do an analysis of equity. So just be aware of that. Okay. So let's start and have a look. So the way I go about doing it, so you see I started with profit for the year. Now you just have a look for each investment company, is there an impact on the parent's profits? Okay, so is there an impact on the parent's profits as a result of intercompany transactions? So what do we know? So remember, group adjustments are twofold. Number one, transactions at acquisition, and number two, what was the number two? Intercompany transactions, okay? So the first one, if you go to the scenario and you look under FIFI, right? So the first one that relates to FIFI is got to do with, in the second paragraph with that, what was it called now? Let me just see what's it called. The contingent liability. Okay, so in that paragraph, you can see that at 15 July 2017, a number of customers found mealworms in chia seeds packed and distributed. Okay, the legal claim was instituted. The group lawyers were of the opinion that the claim against PP will probably not succeed. So on 1 September, the fair value of the claim, taken into account all possible outcomes, was determined at 280,000 Thai baht. Okay, that was gold. The amount of any settlement will be tax deductible in Thailand. Okay, so what we must understand is the following: that at the date of acquisition, the company needed to take into account the contingent liability of 280,000 Thai baht. Okay, so just take note of that. So 2 paragraphs down, where did they say that? Oh yeah. So on 31 December 2017, they're saying that FIFI settled the claim relating to the mealworms for 450,000 Thai baht. Now let's understand what actually happened. Okay, so this is where you need to understand what happened from a separate company point of view and what's happening from a group perspective. So what you need to understand that on 15 July, there was a claim instituted, right? The legal team of FIFI said that they don't think that the claim will succeed. So for them, it was not a provision or anything of that nature. It was a contingent liability. A contingent liability is not recognized on the balance sheet. All that happens with a contingent liability is that it is disclosed in the notes to the financial statements. So it had no impact on the financial statements from a numbers point of view. All that is happening, it is sitting in the notes to the financial statements, so users can know that there is a possible claim. So that is in the books of FIFI, the separate company. However, from a group perspective, when there is a particular contingent liability, like in this case, then at the date of acquisition, the group needs to recognize the contingent liability. So therefore, from a separate book point of view, there is no liability, whereas from a group perspective, there is a liability of 280,000 Thai baht. Okay, so that's important to take note. Now, so this happened on the 1st of September 2017 in the current financial year when we acquired the company. Now, what? Oh, now on 31 December 2017, there was an actual settlement. So on 31 December 2017, FIFI did the following. FIFI said debit expense, legal expense, credit bank. Okay, so credit bank 450. I'm not going to, 450. So that is what FIFI did. Now, from a group perspective, we have already taken into account 280,000. So our expense cannot be 450. Our expense must be 450 minus 280. We already said that we have a liability at 1 September of 280. So therefore, what must go through the income statement must be the difference between what was actually settled and what we already raised. Okay, so what must go through the income statement from a group perspective is 450 minus 280. That is, let's just check. Let's see. What is that? So what must go through is 450 minus 280. So what must go through is only 170. So what you must know, so this is the important aspect, that sitting in the profit or loss of FIFI is an expense of 450. But what does the group want? The group don't want 450. The group wants 450 minus 280. The group only wants 170. So that is an adjustment we need to make, and that is an adjustment, that is a group adjustment relating to a transaction at acquisition. Because at acquisition, we raised a liability of 280,000 Thai baht. What you must just take, this concept you must get in your head, that whatever adjustment we make at acquisition, whatever adjustment we make, whether it's a fair value adjustment relating to assets or liability, or whether it is an adjustment relating to recognizing an additional asset or an additional liability, like this is an additional liability, the contingent liability, it is just basically going to reverse later on. Okay, so we recognize it at acquisition, and in future periods, it will be reversed. So for example, a fair value adjustment relating to PPE will be reversed as we depreciate the extra depreciation. For land, it's when we sell the land. For inventory, is when we sell the inventory, stuff like that, or when we write it down. So same thing over here. We raised a liability, and the liability will be reversed once it is settled. So as you can see, the liability was settled on 31 December, but we already recognized a 280. So what must go through our profit or loss is not 450, but rather 170. So what do? Whatever we recognized at acquisition needs to be reversed. Okay, so that's important. The only trick over here is the following. The only trick over here is going to be the following. Is that on 1 September, we used a particular exchange rate. So here at 31 December, we will use a different exchange rate. Okay, so that is something you might just be aware about. Okay, so is there any questions on that contingent liability situation? So you might just be aware of this. So it's going to be the first adjustment that we will do. So if you have any question on it, please just let me know. Okay, so we'll just be aware of that. Actually, I don't want to do that adjustment now because that is relating to the profits of FIFI. I'm doing the profits of Mumbai. I just take note of that one. Okay, so that adjustment we're not going to do over here because it's not impacting the profit of Mumbai. It's going to impact the profit of FIFI. So we're busy with the profits of Mumbai. So that's one you might just take note of. Okay, so what is this during the current year? Okay, so here the intercompany sale. We say during the current year, Mumbai sold inventory to FIFI. On 31 August 2018, inventory purchased from Mumbai amounted to 47,500, was still on hand. Total sales from Mumbai to FIFI for the 2018 financial year amounted to 100,000. Mumbai sells inventory at a markup of 20% on costs to FIFI. So because Mumbai is selling to the sub, because the parent is selling to the sub, the profit is sitting in the books of the parent. So therefore we need to adjust. Therefore we need to adjust the parent's books. Okay, so just take note of that. So therefore we're going to have to adjust the parents' books. So how we're going to do this is as follows. So I'm going to, so remember, it's very important to know whose profit you're adjusting, okay? So because Mumbai is selling to Fifi, Mumbai is making the profit. So therefore we adjust the profits of Mumbai. Had this been other way around, had it been that Fifi is selling to Mumbai, then who's making the profit? The sub is making the profit. So therefore, when we make the adjustment, we need to adjust the unrealized profit in the subs books. That is very, very important, because if you make the adjustment in the wrong profit, then NCI will automatically be wrong. Okay, so just be aware of that. So here I'm going to say intercompany inventory, intercompany inventory, intercompany inventory. So I'm going to say, we're going to say who it relates to. So intercompany inventory. So remember, the inventory on hand at 31, what's our date again? At 31 August 2018 is 47,500. Okay, so 47,500. That is Thai baht. Okay, so 47,500. But we're not going to remove the full 47,500. We only want to remove the unrealized profit included in the 47,500. So what we do, we multiply by the unrealized profit, which is 20%. It's a markup on cost. So it's 20 over 120. If it was markup on sales, then it will be 20 over 100. So when the markup is on cost, you will just say cost plus markup. 100 plus markup. If it is on sales, then the denominator is simply 100. Okay, so there we go. So we're saying 47 times 20 over 120. That answer will give you the unrealized profit. So 47,500 times 20 over 120 will give you the unrealized profit. But remember, we're dealing with the profit for the year. So it needs to be an after-tax figure. So it needs to be an after-tax figure. So we're going to say multiply by 0.72, okay, or 0.72. But so now we have the unrealized profit after tax. If you want to, you can show tax separately, it doesn't matter. Okay, but it's much easier just to show the tax over here, because otherwise you have to write another line. Okay, so here we're saying this is the inventory. Included in the inventory is this unrealized profit, so that's what we want. But we want it to be after tax, so therefore we multiply by 0.72. But now remember, we are dealing with ZAR. So this 47,500 is in Thai baht. So now we need to convert it into ZAR. So to convert it into ZAR, let's just see what's the exchange rates. Okay, so we take it unrealized profit as at 31 August 2018, because that's the inventory that's on hand, and inventory is an asset, and we're removing it from inventory. So therefore, one rand equals so much Thai baht. So very important, to convert, we must divide, not multiply. If it was 1 Thai baht equals so much rand, then we must multiply. So just be aware of that. Okay, so take note of how the exchange rate is given. So because it's for every 1 rand, it is so much Thai baht, we will say divide by 950. If they gave us the Thai baht, if they gave us the number of rands for each Thai baht, then we multiply. Okay, so please take note of that. So this is what I'm going to do. So I'm going to say equal 47,500, the inventory. Included in inventory is unrealized profit of 20 over 120. But that's going to give me 100%. I don't want 100%. I want, that's going to give me before tax. I don't want before tax. I want after tax. So therefore it is 0.72. And then I'm going to say, okay, that divided by, but that's in Thai, but now I want to convert it into ZAR. So I say, what just happened here? Nothing. 9.50. So I use the rate at year end because that is the inventory balance at year end. Okay. So there we go. It is 600, but remember, we are removing unrealized profit. It must decrease profit because included in the profit is the 600 Rand. We don't want it, so therefore it is minus. Okay, so that is still for Fifi. Now we go and look at this more. So we dealt with, where is this now? So we dealt with Fifi during the current year. Okay, then I see on 31 August, Mumbai sold 50,000 of their shares in Fifi for 300,000 after the sale of these shares. Mumbai still had control of Fifi as per the definition of control in accordance with IFRS 10. So on 31, they sold 50,000 of their Fifi shares for that amount. Okay, so now we must have a look whether there was a profit or loss that was made. Okay, because they sold 50,000 of their shares for that amount. We will have to have a look what was the cost of, or the carrying amount of these shares at the date of sale. And then we need to have a look if there was any gain or loss on the sale. Because remember, when Mumbai sold the shares, let's say they made a gain. Okay, so let's say they made a gain. Let's say they made a profit on the sale. So if they made a sale, if they made a profit on the sale, they would have correctly included the profit in profit or loss. However, from a group perspective, because the change in ownership resulted in a sub before and after, the profit or the gain or loss on that sale cannot be included in profit or loss. Why not? Because what now? Oh, because it is a transaction with the owner, and transactions with the owner cannot be included in profit or loss. Okay, so be aware of that. Okay, so let's have a look over here. So this is going to be sale of shares. Okay, and it's going, once again, it relates to Fifi. Okay, so I'm going to have another calculation for it. So I'm going to call it working tool. Okay, so proceeds, carrying amount, and that's going to give me gain or loss. Okay, so it will give me gain or loss. Okay, so remember the proceeds was 300,000, whatever it was, and the sale took place on, when did the sale take place? The sale took place on 31 August 20, yeah, the sale took place on 31 August 2018. So the exchange rate at 31 August 2018 was 9 Rand 50. Okay, so we know that it was 9 Rand 50. So all I'm going to say, so I can't say, I'm going to say divide by 9.5. So therefore, we're going to say 300,000 divided by 9.5. Okay, so that was the proceeds in ZAR. Now we must work out the carrying amount. The carrying amount would simply be whatever they paid for Fifi, and work out a percentage of that. So let's go up to, so if you go to the trial balance, so you can have a look. So go to the trial balance and look for investment. Okay, so you can see for investments, the investment amount is sitting at 114,764. The investment amount is sitting at 114,764. Okay, so that's 114,764 represents the cost of Fifi based on the number of shares that we acquired. So we acquired 70% of the ordinary shares in Fifi. Fifi has, how many shares does Fifi have? Fifi has 500,000 shares. Okay, so Fifi has 500,000 shares. So the number of shares that we acquired was as follows. So Fifi, we acquired 70% of the 500,000 shares. Okay, so let's just do it over here, working 3. Okay, so cost of Fifi investment was 114,764. Okay, number of shares, it is 500 times 70%. We acquired 70% of the ordinary shares, and Fifi has 500,000 ordinary shares. So therefore, the number of shares is 500, 1, 2, 3 times 70%. Okay, so number of shares acquired. Okay, so it is 350,000 shares. How many shares did we sell? Okay, so we sold 50,000 shares. So the percentage of the percentage of shareholding that we sold is as follows. So percentage sold, percentage interest sold. So the percentage interest sold is 50,000 shares divided by 350,000 shares. So therefore, the percentage that we are selling is 50 divided by 350. So we sold 15%. Okay, 15.29%. So therefore, percentage of carrying value sold. So percentage of carrying amount not percentage, so value of carrying amount sold. So value of carrying amount sold would be as follows. Total carrying amount for 350, we sold 14%. So therefore, that is the amount that we are disposing of. Okay, so that is the amount that we are disposing of. Let me just quickly see, what was our investment quickly? What was our investment? Sorry, let me just see. Oh no, I don't know what I was looking at. I was gonna change that quickly. What was I looking at? Investments. Yeah. Okay. Sorry. I must have a look at this amount over here. So if you go to the Fifi thing, go to the paragraph on page 46 and look under Fifi, and you will see in the first paragraph, the last sentence, they will say Mumbai settled the acquisition with a cash consideration of 1.6 million Thai baht. Okay. So on 1 September, it was 1.6 million Thai baht. So I just want to fix that up quickly. I made a mistake. So this is not our, what you call it? This is not our cost. Our cost is going to be 1.6 million. We paid 1.6 million, and we're going to divide it by the exchange rate at 1 September 2017. So the exchange rate at 1 September 2017 is, I don't know what it is. Let me just see quickly. Is what? The exchange rate 1 September. So the exchange rate at 1 September was 11 Rand 95. So the exchange rate at September is 11 Rand 95. So I'm going to say 11.95. So if I work this out, the cost of the investment in the Rand value is 1.6123 divided by 11.95. So the actual cost of the investment is 133,895. So the percentage of the carrying value that we are disposing of is still 14.29 because it's 50,000 shares over 350,000. So the carrying value that we're selling is 19,000 Rand. So if I equal that over here, I'm going to say this is working 3. Okay, so that is working 3. So you can see we sold for 31. It is worth 19. So we made a gain. The gain that we are making is 31 minus 19. So the gain we are making is 12,000 Rand. Now the group don't want that gain. Okay, the group don't want that gain. The reason being is that gain is a transaction with the owners, and any transaction with the owners needs to go directly through the statement of changes in equity. Okay, so that must go directly through the statement of changes in equity. Okay, so just be aware of that. So what am I going to do? Included in Mumbai's profit, is a gain of that amount. But we don't want that gain to be included in over there. Why? So it's correctly included in Mumbai's separate profit or loss. However, from a group perspective, we don't want it. Why not? Because it is a transaction with the owner. Transactions with the owners should not go through the income statement. So because it's a profit, we need to remove it. We need to subtract it. Now I'm going to say this must go to working 2. Okay. Okay, so that is a Mumbai profit intercompany inventory from Fifi and the sale of shares of Fifi. Okay, now let's go and see there's more stuff for Fifi. Okay, so we have covered everything over here relating to Fifi. We did that one. Yeah, so we did everything. Can't say anything else. Don't forget the contingent liability that will go under when we deal with Fifi's profit or loss. Now let's move on to New Delhi. So under New Delhi, you can see that Mumbai acquired 25% of the ordinary shares of New Delhi. Okay, the company is incorporated. Okay, New Delhi's net asset value was considered to be fairly valued. Okay, there's a fair value adjustment. So you can see in that first paragraph under New Delhi, there is a fair value adjustment relating to equipment. The carrying amount was 515, but the fair value was 580. So there is going to be a fair value adjustment. Now that does not impact. Now that fair value adjustment does not impact Mumbai's profit. It only impacts the profit of New Delhi. So when we come to the profit of New Delhi, we will take that into account. Are you the only, can anyone else hear? Ticket sensor, he can't hear.
I can hear.
Okay. So just be aware of that. Okay. In the second paragraph under New Delhi, you can see there was inventory sale, but it has been New Delhi was selling to Mumbai. So the profit is included in New Delhi's profit or loss. So when we come there, we will make the necessary adjustments. So there's no impact on Mumbai's profit. Okay, so here's other comprehensive income. That's what other comprehensive income you're not going to deal with. So the last paragraph got to do with other comprehensive income. We're busy with profit or loss. Okay. Okay, so now, so under New Delhi, there are intercompany transactions, but it's going to impact New Delhi's profit or loss. We will deal with that just now. We're still focusing on Mumbai's profit or loss. So the next is Kolkata. So we know what we call it, acquired, Mumbai acquired a controlling interest of 80% on 1st August 2018. Okay, so just be aware of that. And then they are saying there was a purchase agreement, there's a contingent consideration. Okay, so have a look at the contingent consideration. So the contingent consideration on 1 August 2017 was 25,000. On 1 August. Then on 31 August 2017, it was 30,000. But we are not in the 2017 financial year. We are in the 2018 financial year. In the 2018 financial year, the fair value of the contingent consideration is now 42,000 Rand. So that must impact, that will impact Mumbai's profit from a group perspective. Okay, so what you must know, that we need to make a payment. So because the contingent consideration is increasing, the liability is increasing. The liability increases on the credit side. For every credit, there must be a debit. The debit will go against fair value adjustment relating to contingent consideration. So because it's a debit, that means it is increasing the expense. An increase in an expense reduces profit. Okay, so therefore, we're going to subtract. So what we're going to do, we will go over here. We're going to say fair value adjustment, contingent consideration, Kolkata. The fair value is now 40,000. It's currently sitting at 30,000. I mean, not 40,000, 42,000. The fair value is 42,000. It's currently sitting at 30,000. So therefore, it is we're going to say 42,123 minus 30. Because it is an increase in a liability, it means it's an increase in an expense. An increase in an expense reduces profit or loss. Okay, so just take note of that. Okay, so that is Kolkata, that is the unrealized profits. Okay, what was I thinking now? So now let's have a look if there's anything else relating to Kolkata that impacts Mumbai's profits. So if we read further under Kolkata, we can see retain amount. Okay, we have that. With the exception of items listed below, all assets and liabilities of Kolkata were deemed to be fairly valued. So we can see carrying inventory was undervalued and the receivables was overvalued. And then they're saying the inventory on hand on 1 August 2017 was sold during the 2018 financial year. So as you can see, So, and then, okay, and the receivable balance on 1 August was written down to its net realizable value on 31 August 2017. So here you must understand now the inventory, at the date of acquisition, which was 1 August 2017, inventory had a carrying amount of 20,000 and a fair value of 36,000. So that means at the date of acquisition, the group made a fair value adjustment of 16,000 Rand. Similarly, for receivables, the carrying amount was 27,000 Rand and the fair value was 20,000 Rand at the date of acquisition on 1 August 2017. So at that date, the group made a fair value adjustment downwards of 7,000 Rand. Now, they are telling us that the receivables was actually written down by Kolkata in the 2017 financial year. Okay, so that is going to have an impact on our opening retained earnings because we are dealing with the current financial year. 2017 relates to the prior financial year. But for the inventory, they are saying that the inventory was actually sold in the 2018 financial year. So this is how you must picture it. In the books of Kolkata, they have the inventory of 20,000 Rand. So when they made the sale, the journal entry would have looked as follows. They would say debit bank, credit revenue, for whatever amount they sold the revenue, the inventory at. Then the other side of the journal entry would have been debit cost of sales, 20,000, credit revenue, 20,000. Okay, so that is how Kolkata in their separate books would have processed the journal entry, because according to them, the inventory is at 20,000 Rand. However, from the group perspective, they don't want, from the group perspective, inventory is not 20,000 Rand. Inventory is 36,000 Rand. So what does the group want to process? The group's journal entry want to be debit cost of sales, 36,000, credit revenue, 36,000. That is what the group wants. But the group already have what Kolkata has. The group already has the 20,000. So all the group have to do is make that 16,000 Rand adjustment. So once again, like I told you, any fair value adjustment at acquisition eventually gets reversed in future. So over here with inventory, the inventory fair value adjustment at acquisition gets reversed once sold or once written down. Okay, so whichever way. So in this case, all we have to do, the fair value adjustment that we would have done at 1 August 2017 now needs to be reversed in the 2018 financial year. So that 16,000 Rand fair value adjustment must now be reversed. So remember, what is it going to do to profit or loss? It's going to decrease profit or loss. There are two ways to think about it. At acquisition, on 1 August 2017, we made a fair value adjustment upwards. We said debit inventory. Okay, so we said debit inventory, we increased inventory. Now we are going to reverse that adjustment. So by reversing it, we're going to have to say credit inventory. For every credit, there must be a debit. The debit goes against cost of sales. By debiting cost of sales, you are increasing cost of sales. Cost of sales is an expense. If you increase an expense, you are decreasing profit or loss. Okay, so that's the one way of looking at it. The other way of looking at it, and it's one and the same thing, it's just different ways of thinking about it, but it's basically the same thing. And that is, when the journal entry was processed by Kolkata, the separate entity, they said debit cost of sales, credit inventory, 20,000 Rand. What do we need to do? We need to say, the group needs to do debit cost of sales, credit inventory, 36,000 Rand. So as you can see, we're missing a 16,000 Rand, and that is just basically the reversal. So just be aware of that. Okay, so all I'm going to do I am going to reverse the inventory. Okay. Okay, so just be aware of that. Okay, so yeah, so that is important to take note. But once again, just take note, we're not going to adjust this in Mumbai's books. We're not going to adjust that inventory reversal in Mumbai's books. We're going to adjust it in Kolkata's books. So I'm not going to do it now. I'm first busy with Mumbai. Okay, just so you know, a better way of actually doing it. A better way of actually doing it. I'm not doing it the how I would usually do it. So what I am doing is what I do, but but what I usually do is that, and it's easier when you're using Excel, is to set up each calculation. As we have over here. Is to set up, yeah, I have Mumbai. Then I would make a heading for Fifi. I'll make a heading for Kolkata. I'll make a heading for New Delhi. So as I go through the scenario, I adjust it as I go along. Okay. At this point, I'm working a little bit backwards in the sense that I'm only focusing on Mumbai. Then I must go back and then look again at Fifi and go back and get so forth. So just actually, I didn't work in the actual smart way. So what you do, you'd actually put a heading for Fifi, you put a heading for New Delhi, for Kolkata. So as we go along the scenario, we impact the relevant profit as we go along. But anyway, I already did it this way now, so let's just continue. Okay, so now let's have a look if there's anything further we need to do. Okay, so they're saying there's interest in the preference shares. Okay, so that is the preference shares, we'll deal with that just now. So here they say Mumbai sold equipment to Kolkata. So Mumbai sold equipment to Kolkata. So Mumbai made the sale. Because Mumbai made the sale, Mumbai has the unrealized profit. So therefore included in Mumbai's profit is overstated. Okay, so we need to adjust, we'll need to adjust we'll have to adjust Mumbai's profit. So they say Mumbai sold equipment to Kolkata at 75,000 Rand. Mumbai sells equipment at cost plus 25%. So it is as cost plus 25%. So what we're going to do, we're going to make the necessary adjustment. So remember, when you make an intercompany sale of a depreciable asset, there are two adjustments. The one, elimination of the unrealized profit, and then also to impact depreciation. So this is going to be intercompany sale of equipment. And the amount, the equipment is 75,000 Rand. The equipment is 75,000 Rand. The profit on the equipment is 25% on cost. So once again, it's 25 divided by 125. Okay. And so that is, and then we also want it to be after tax. Okay. So don't forget about tax. We're going to say 0.72. So all I'm going to do over here, I'm going to say equal 75,000 times 25 divided by 125 times 0.72. Okay, but remember, it's an unrealized profit, so we want to remove it. So therefore we say minus. Okay, so just a few things you must take note of. Don't forget you don't forget the tax implication. Don't forget to identify the direction, whether it's an add or subtract. And then also don't forget be cognizant of which period, because if it's in the current period, you impact profit or loss. If it is in a prior period, you impact opening retained earnings. Okay. Okay. So what's important to understand is that there's also going to be an impact on depreciation. So because Kolkata bought the equipment at an amount that is higher than the group wants. So remember, Kolkata has the equipment at 75,000. So what they are doing is they are depreciating equipment based on 75,000. But to the group, the equipment is not 75,000. The equipment is 75,000 less the intercompany sale, less the intercompany profit. So therefore, from the group perspective, depreciation is overstated. So from the group perspective, depreciation is overstated. So therefore, we need to reduce depreciation. By reducing depreciation, we are reducing an expense. By reducing an expense, we are increasing profit or loss. Now, this is something important to understand. Although the depreciation is sitting in the books of Kolkata, because the transaction originated in the from Mumbai. Mumbai made the profit. Because the transaction originated from Mumbai, and because the profit is sitting in Mumbai, we make the depreciation adjustment also against the profits of Mumbai and not the profits of Kolkata. So that's very important to take note. Because the sale originated from Mumbai, the entire transaction is adjusted against Mumbai's profits. The other way is true as well. If the transaction originated in Kolkata, then the entire transaction adjustment will be against the profits of Kolkata. So although Kolkata's depreciation is overstated, we don't impact Kolkata's profits. We're going to impact the profits of Mumbai. Okay, so just be aware of that. Okay, so they thought depreciation is 20%. So all you do, you take the opposite of that number and you multiply it by 20%. It's a full year, so therefore there's no need to multiply by the number of months. If it's only for part of the year, then we'd have to adjust for the number of months, because depreciation is based on time. Okay. So that was that intercompany sale. I think there was inventory also. Let's just have a look. Yes, so here's in the company inventory sale. So what we have to have a look, who made the profit. So they say Kolkata purchases all its inventory from Mumbai at a gross profit of 20%. When it's a gross profit, it means on sale. Okay, inventory purchase from Mumbai still on hand at 31 August 2017 amounted to 25,000 Rand. Okay, so here you must understand that who's making the sale? Mumbai is making the sale. As a result, the profit is included in Mumbai. So therefore, what we're going to do with therefore the adjustments must go against the profits of Mumbai. Okay, so if I go to the profits of Mumbai, what do? I will say intercompany sale of inventory. So here we have to say closing inventory, because it's a closing and an opening. Okay. So, and then there's also an intercompany sale of inventory opening. So all you must know when it comes to opening balance, you increase profit or loss. When it's closing, you decrease profit or loss. So the opening balance or last year's close. So 31 August 2017 is the prior year. That's the closing balance of the prior year. The closing balance of the prior year is the current year's opening balance. So an opening balance in the current year, we realize the profit, so we add it back. So the inventory on hand last year was 20,000. Included in the 20,000 Rand was an unrealized profit of 20% on gross profit. Because it's 20% on gross profit, that is basically a markup on sales. So we say 20 divided by 100. Now, once again, we want an after-tax amount. So I'm going to multiply by 0.72. So I'm going to say 20, 1, 2, 3 times 20 divided by 100 times 0.72. I'm adding it back, so therefore it is a positive. Now for the closing inventory. For the closing inventory, what is the closing? The closing inventory is what now? So if we go to the balance sheet on Kolkata, because all inventory is from Kolkata. So we go to the balance sheet inventory. Where's inventory? You see, okay, here's inventory. So under Kolkata, the inventory is at 45,000 Rand. So all I'm going to do this is not 20, this is 25. 25. Okay, closing inventory, the closing balance is 45,000. Included in the 45,000 is an unrealized profit of 20% on gross profit. So we say 20 over 100. If it was on cost, it would be 20 over 120. We want it after tax, so we say 0.72. So this must, so we're going to say equal, open bracket, 45, 1, 2, 3 times 20 divided by 100 times 0.72. So because there's a closing balance, so therefore we want to remove the unrealized profit, so we have to decrease profit or loss. Okay, so just take note of that. Okay, so we went through all of the scenario, and we adjusted for all intercompany transactions that impacted the profits of Mumbai. We adjusted for all transactions at acquisition that impacted the profits of Mumbai. What they're never going to tell you, and you must always be aware of this. So generally, I always tell students just do it first, because I used to forget about it, because you in a rush and all of those type of things. So what I always used to say is first, write that first down, and that is, don't forget dividend income. So remember, the group companies would have declared a dividend. By default, because we have an investment in those companies, we'd have gotten our portion, and our portion is considered intercompany. So therefore, included in Mumbai's profit is dividends received or dividend income earned from the investment companies. From a separate book point of view, that's totally fine. From a group perspective, it is not okay, because it is an intercompany transaction. So then we're gonna have, so what we're gonna have to do is remove dividends. Okay, eliminate dividends. So never forget dividends. Okay, So we would have so it'd be Fifi, it would be New Delhi, and it would be Kolkata. Okay, so if we go to the income statement, if we go to the trial balance, if we go to the trial balance, the trial balance told us the dividends that were declared. So on 31 August, what's happening now? Oh yeah, okay. So ordinary dividends declared on 31 August 2018. There was no dividends declared on 31 August 2018 by Fifi. There was a 60,000 Rand dividend declared by Kolkata, and then, by New Delhi, and then by Kolkata. Okay, so we actually need to make it more clear because there's a preference and an ordinary dividends. Okay, so this is elimination of ordinary dividends. Okay, and then we have to eliminate preference dividends. Eliminate preference dividends. Okay, so let's do eliminate ordinary dividends for Fifi. So Fifi declared a dividend on 31 July 2018 of 400,000 Thai baht. So we need to ask ourselves, at 31 July 2018, what percentage of Fifi did we own? So let's have a look. I can't remember actually. So 31 July. So remember on 31 August, we decreased our shareholding. So at 31 July 2017, we still held our original shareholding of 70%. So therefore, if I say Fifi, they declared 400,000. Of that 400,000, 70% belongs to us. But remember, this is in Thai baht, so therefore we need to adjust for the exchange rate. The exchange rate at 31 July 28. We'll just check what did I just read there now. Yeah, 31 July 2018, the exchange rate was 10 Rand. Okay. Exchange rate was 10. So for Fifi, we need to say equal open bracket 400,000, 1, 2, 3. Of that 400,000, we got 70% because that was our interest at that date, and then we divided by 10. So we received 28,000, but we need to decrease because included in our profit or loss is at 28,000. We don't want it there. It's in the company, so therefore we remove it. Okay, the next is going to be Kolkata. Okay, so for Kolkata, New Delhi. Let's do New Delhi. That's the order. So for New Delhi, what happened for New Delhi? New Delhi declared a dividend of 31 August 2018, 60,000 Rand. At 31 August 2018, how much did we own? There was no change in ownership, so we only had a 25%. Okay, so we had a 25% interest. So therefore, the dividend we would have earned is as follows. It is 60,000 Rand. Our interest at 31 August 2018 was 25%. So therefore, we need to remove 60,000, 1, 2, 3 times 25%. So we're removing 15,000 Rand. Then for Kolkata, let's go back to Kolkata. On 31 August 2018, Kolkata declared a dividend of 30,000 Rand. And at 31 August 2018, our interest in Kolkata was 'interest in Kolkata'. There was no change in ownership over here. No. So our interest in Kolkata is 80%. So our interest in Kolkata is 80%. So there was no change in ownership. So at 31 August 2018, we had 80%, so 30,000. And all that 30,000, we received our interest of 80%. So therefore, what we need to remove is 30,000, 123 times 80%. Okay, so we have to remove 24,000. Now there was preference shares at Kolkata distributed. So we need to also remove that as an intercompany transaction. So Kolkata, so what you must, so we have to have a look now. Okay, let me just see what percentage did we buy. With preference share capital 20,000. And I'm trying to see where's the percentage that we acquired of the preference shares. So okay, so Kolkata issued 2,000 shares at 10 Rand each. So that gave them the 20,000 Rand. Okay, so how much of that do we have? Oh, so you can see we have 1,000 preference shares of Kolkata. So if you look at the trial balance under investments, you will see we have 1,000 preference shares of Kolkata. Kolkata issued 2,000 shares. So therefore, what percentage of the preference shares do we have? 50%. So therefore, the dividends that they declared of 18,000 Rand, we would have gotten 50%. So those would equal, so 18,000 preference dividends declared multiplied by 50%. How did I get 50%? We own 1,000 of the 2,000 shares that they issued. So therefore, we want to remove our percentage, which should be 9,000 Rand. 18,000 times 50%. Okay. So therefore, we should have removed that amount. So so when we add this up, I generally like to put a space just in case I missed something. So I leave a space. So so this is Mumbai profit, a group perspective. This is what I call it, group. You don't have to write this in the exam. This is just for our purposes, group perspective, 100%. Okay, so now I know this is Mumbai profit only from a group perspective, what the group wants at 100%. So if I add this up, so if I add that up, that is the profit that I get. Okay, so that is the profit that I get for Mumbai. I don't know if it's right or wrong. We'll have to have a look. And then now I say parent portion. So I mean, we don't have to say parent portion over here, because this is the parent. So usually what I would do for each one, I would say parent NCI. But because the parent gets 100%, the full balance belongs to the parent. NCI gets nothing, so there's no need to split. But for each calculation, I will be doing, this is the process I go through. Okay, so you can see I have a start of the profit from the parent, profit as per the separate trial balance. But I know that's not what the group wants. So then I do all the group adjustments. So remember, the group adjustments are twofold. Group adjustments at acquisition and group adjustments of intercompany that impacts the profit number I'm dealing with. I'm dealing with Mumbai's profit. So any of those transactions that impact the profit of Mumbai. Once I do that, I get a profit from the group perspective at 100%. When I say, does everything belong to the parent? For the parents, in a profit, yes. But if this was a subsidiary, the answer would be no. Then I would say, so let's say this was called Qatar's profit. Then I would say, okay, all this 80% belong to the parent and 20% belong to NCI. So I'll do that for each calculation. Okay. I think what we'll do, we'll continue the calculation tomorrow, but we're going to finish the change in ownership calculation tomorrow. So trying to think what. So I say we're going to start 8:30, but I think we need to start actually 8 o'clock because I think I'm going to need an extra half an hour because I have a class right after our class in at 10 o'clock tomorrow, and then I'll start again at 10:15. So I'll be able to push over there. So actually, I'm going to send out a thing later tonight for 8 o'clock. So we can go 8 till 10. Because that's the only way I'm going to actually want to finish this thing. That took a bit long, but for when we do the other profits, it's going to go much quicker because the explanation has been laid, and also a lot of these transactions over here will filter through into the opening and retained earnings. So then I'll also be able to do quick for the opening and retained earnings. And why I'll be able to be quick? Because I already gave a detailed explanation for these over here. So the same level of thinking will impact opening and retained earnings. Okay. So I need to end off over here, unfortunately. I need to go look after my kids now. So we will continue this tomorrow, but we need to start 8 o'clock so that by 10 o'clock we can finish the entire question. Okay. Is there any questions from your guys' side?
How soon will the video be up after this lesson? I mean, like after tomorrow's session, how the videos gonna come?
Hey?
Yeah.
I'll try to do it as soon as possible. Like you see, once I close this, it starts it takes quite a bit of time to convert into Zoom, take about an hour or so to convert it. But because I'm going to be on another lesson, by the time the other lesson is done, it should be done. Then I'll provide it to you guys.
So it's going to be on the Google Drive?
I can upload it to the Google Drive, yeah.
Okay.
Okay, cool. Guys are good to go. There's no other questions. So I'll see you guys. Bye-bye.